You delivered the load, drove 800 miles, burned $600 in diesel at 64 cents a mile, paid your driver at 78 cents a mile. Your operating costs hit $2.27 per mile for that run. And now the freight broker says you'll get paid in 45 days. 45 days. Your truck payment is due in 10. Diesel for next week's loads costs money, NLW. This gap between paying out and getting paid has killed more trucking companies than blown engines or bad freight ever will. 90% of new trucking companies fail in the first year, and the #1 reason is cash flow. But there's a product literally built for this exact problem, and most owner-operators either don't know about it or think it's too expensive. It's called invoice factoring. Let's break down exactly how this works for trucking.
Yeah, I mean, it really is the ultimate bottleneck. Like, you can be the absolute safest driver on the interstate.
Right.
You can negotiate the best rates on the load boards, but if the timing of your incoming cash just doesn't match your outgoing expenses, none of that hard work actually matters.
Exactly. And that is exactly what we are focusing on for you today. In this deep dive, our mission is to explore how owner-operators and small fleet owners can finally stop waiting 30 to 60 days for freight brokers to mail a check, and instead get cash into their accounts within 24 hours.
Yes, within a day.
Because nobody should have to finance the entire supply chain out of their own personal savings.
Right, and just to set some parameters before we dive into the mechanics, we are looking exclusively at the trucking industry today.
Only trucking.
Right. Strictly the unique and frankly really frustrating payment cycle between motor carriers, freight brokers, and shippers. And, the specific financial tools built to bridge this exact gap.
Well, before we jump into the solution, I'm trying to wrap my head around why this gap even exists in the first place. Because, when you drive down the highway, trucking looks like an endless booming gold rush.
Oh, sure. Trucks are everywhere.
Right. It doesn't look like an industry that's struggling for cash.
Yeah, but the scale is kind of deceptive. If you look at the macro data for 2024, the trucking industry moved 11.27 billion tons of freight.
Wow.
Yeah, and that physical movement generated $906 billion in gross revenue.
Wait, 906 billion?
Billion with a B,
Yes.
Yeah. It is a staggering amount of money moving around, but beneath that $900 billion surface, you find a sector built on razor-thin margins and dangerously delayed payments.
But why delayed, though? Like, if I go to the grocery store, I pay for my items right then and there. I don't, tell the cashier I'll pay them in 2 months.
Right.
So why don't truckers get handed a check the moment they bump the loading dock?
It basically comes down to the chain of command. When a trucker delivers a load, they are usually working through a freight broker.
Okay.
And that broker is working for a massive shipper. Think giant wholesalers or huge national retail chains. Those massive buyers dictate the terms of the market.
They have all the leverage.
Exactly. They typically pay the freight brokers on what's called net 30 to net 60 terms, meaning they pay 30 to 60 days after the invoice is submitted.
So the broker doesn't even actually have the cash to pay the trucker until the giant corporate shipper pays them first.
Yes. The pain of waiting just trickles right down the ladder.
Yeah.
And worse than that, we're actually seeing some large buyers and wholesalers stretch those terms all the way out to net 90.
3 full months.
3 full months. And the fundamental flaw in the system is that the trucker's operating costs just cannot wait for those terms. Let's look at the reality of moving a truck in 2024. The average operating cost is $2.27 per mile.
$2.27 for every single mile the odometer turns.
Yep.
That sounds incredibly high. Where's all that money going before the truck even delivers the load?
Well, let's break it down because, the pennies accumulate remarkably fast. First, 64 cents of that goes straight to diesel fuel.
Okay, well, fuel makes sense. You can't cheat physics. You have to burn diesel to move weight.
Right. Then you have driver wages. That takes up another 78 cents per mile. And we should note, those wages are up 7.6% year over year.
Oh, I imagine that's tied to the ongoing driver shortage we keep hearing about.
Exactly.
Youths are having to pay a premium just to keep a qualified person in the driver's seat.
That's a major factor, yeah. Next, you have to account for maintenance. Tires, oil changes, engine parts. That averages roughly 20 cents per mile.
Okay.
And finally, insurance premiums. We've actually seen a recent spike of 12.5% in insurance costs across the industry.
Ouch. That's brutal.
Yeah, it adds roughly another 10 cents per mile. So when you add all that up, before a single dollar of revenue actually clears the bank account, $2.27 is leaving the trucker's wallet for every mile driven.
Okay, let's unpack this, because here's the part that I find genuinely shocking.
Yeah.
We aren't talking about massive corporate mega fleets eating these upfront costs, right?
No, not at all.
The data shows that 95.5% of all carriers operate 10 or fewer trucks. The vast majority of this industry is made up of small, family-run businesses. They don't have multi-million-dollar corporate lines of credit. They don't have bottomless cash reserves to bridge a 45-day gap.
Right, which means they are physically financing the movement of the nation's goods out of their own personal pockets.
I mean, it's like running a high-end restaurant where you have to buy all the ingredients, pay the chef, and cover the rent today, but your diners tell you they'll pay for their meal 2 months from now.
That is a perfect analogy.
It's like the small trucker is acting as a zero-interest, unsecured bank for multi-billion-dollar mega corporations.
Viewing it as an unsecured zero-interest loan is a very accurate way to understand the burden. To really grasp the pressure this puts on an owner, we have to move from the industry-wide billions and look at the monthly reality of a specific small fleet.
Let's do it.
Imagine a 3-truck operation.
Okay, let me walk through the real math on that.
Yeah.
Say I own 3 trucks. We are running hard. Each truck does 4 loads a week, and let's say they average $4,500 per load.
Okay, pretty standard.
That is $18,000 in revenue per truck every single week. Multiply that by my 3 trucks, and my fleet is generating $54,000 a week.
Great. So over the course of a month, your gross revenue is a highly profitable sounding $216,000.
Yeah. On paper, I've built a highly successful $250,000 a month business.
But that is the ultimate trap. Because of those net 45 or net 60 terms, without factoring, you don't actually have that $216,000.
Right. It is just numbers sitting on unpaid invoices.
Exactly. It's phantom money. Meanwhile, your actual physical business checking account might only have $5,000 left in it.
Just $5,000, because my bills completely ignore those 45-day terms.
Yep. Those 3 trucks are still burning diesel, your drivers expect their paychecks every Friday, and, the insurance company wants their premium on the first of the month.
Oh, absolutely.
Your weekly expenses to keep those 3 trucks moving hit roughly $36,000, covering the fuel, wages, insurance, and maintenance.
Wow. I need $36,000 in hard cash every single week just to survive.
Right, so over a 4-week period, you need to physically spend $144,000 in cash.
$144,000.
Just to keep the doors open while you wait for those broker checks to finally arrive.
$144,000 in cash out the door before I see a dime of my own revenue. I mean, almost no small business owner running 3 trucks has that kind of liquid cash sitting around in a checking account.
No, of course not.
That weight will bankrupt a completely profitable company.
And this highlights a crucial reality about the trucking industry. It isn't a bad business model. It is a good business with a fundamentally broken payment cycle.
Yeah.
And since they don't have that cash sitting around, they need a mechanism to survive. This is exactly where invoice factoring comes into play.
Okay, I want to understand the actual physical mechanics of this. Walk me through it step by step.
Sure.
I deliver a load and generate an invoice. Say it's $4,500 for a run from Portland to Denver. Instead of waiting 45 days for the broker, what do?
You sell that invoice to a factoring company.
Selling an invoice. So the factoring company advances me the money.
Exactly. They advance 90% to 100% of the invoice value within 24 hours.
Oh, wow. Fast.
Very fast. So let's say you have a 97% advance rate. You get $4,365 deposited into your account by tomorrow.
And then what happens? I mean, who gets the rest?
When the broker finally pays the full $4,500 in 45 days, the factoring company keeps their fee, which is typically 1% to 5% of the invoice, and sends you any remaining balance.
Well, let's pause and look at the actual cost of that transaction, because I want to emphasize the cost transparency here.
Yeah, let's do the math.
So on that $4,500 invoice at a 3% fee, you paid exactly $135 to get your money 44 days early. That's the full cost. It's not a monthly interest rate. It's not a compounding fee. Just $135.
Exactly, just $135. And that clears up a massive misconception. This is not a loan.
Really?
Really. There is no debt added to your books, no monthly payments, and no interest rate. You are simply selling a receivable. That's it.
Wait, so my credit score doesn't matter?
Factoring is based on your customer's credit, not yours.
No.
The factoring company is buying the broker's obligation to pay. If the broker is creditworthy, a trucker with a 520 score can factor their invoices.
Oh, that completely flips the script. Because if I'm a brand new owner-operator, my personal credit might be completely maxed out.
Oh, absolutely, from buying the truck.
Right. But because I'm hauling freight for a massive brokerage, the factoring company is looking at them, not me.
Exactly. It makes it so much more accessible. Now that we know how it works, though, How do carriers choose the right strategy? Because not all factoring agreements are built the same.
Yeah, picking the wrong one sounds like it could be pretty dangerous.
It can be. The biggest difference is recourse versus non-recourse factoring.
Okay, what's the difference?
With recourse factoring, you are on the hook to buy back the invoice if the broker doesn't pay.
Wait, really? If the broker defaults, I have to give the money back.
Yes. But because the factoring company takes less risk, it features much lower fees.
Ah, I see.
On the other hand, non-recourse factoring means the factoring company absorbs the loss if the broker goes bankrupt.
Okay, so I'm protected.
Right. But it has higher fees because of that protection.
With cargo theft up 40% and freight fraud surging, non-recourse is worth the extra cost. I mean, you need that protection.
A lot of carriers feel exactly the same way right now.
Okay, so that's the risk side. Are there different commitment levels too?
Yes, there's spot factoring versus contract factoring.
Spot factoring, like the spot market.
Similar concept, yeah. Spot factoring lets you factor individual invoices whenever you want with no commitment. It's great for occasional use.
And contract factoring.
Contract factoring means you agree to factor all or most of your invoices with them. But, in exchange, you get better rates due to the volume.
That makes sense. Oh, there's one final tool I wanted to bring up that's often bundled with these programs.
Fuel advances.
Yes, fuel advances or fuel card programs. Because, this covers the diesel before you even deliver the load.
Right, which is huge. It allows cash-strapped owner-operators to physically get the truck moving.
Exactly. You get the fuel money up front, so you aren't stranded.
It's all about keeping the wheels turning.
So, to summarize for you listening, succeeding as a small trucking company isn't just about finding good freight and driving safely.
No, it's really not.
It's about mastering cash flow. Factoring transforms a 45-day waiting game into instant liquidity, allowing carriers to focus on moving the next load rather than chasing down the last check.
It changes everything. But, I do want to leave you with one final concept to mull over.
What's that?
Well, factoring works beautifully because it relies on the strong credit of massive freight brokers.
Right.
But what happens if a major, seemingly reliable freight broker suddenly goes bankrupt during an economic downturn?
Oh, wow.
Right. If a factoring company is suddenly holding millions in worthless receivables, how does that ripple effect impact the small truckers who rely on them?
Man, if the big domino falls, it takes everyone down with it. That is a sobering thought, but definitely something to explore on your own as you look at the whole supply chain. Well, that wraps up our deep dive for today.
Keep an eye on those finances.
We'll catch you next time.